Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Rines, initial contributor at Core DAO, Dan O'Prey, Chief Product Officer at Bakkt, and Rika Khurdayan, U.S. Chief Legal Officer at Bitstamp. They join me to discuss the purpose, mechanics, and significance of the Bitcoin halving event. It is great to have you all with us. Welcome to Trade Talks, and we'll go around the horn here quickly. Rich, just give the viewers a brief explanation of where you sit within the digital asset ecosystem.
Hey, great to talk again, Jill. So Core is an L1 blockchain trying to unlock the $1.5 trillion of trapped Bitcoin liquidity. It's a full ecosystem that's been live for a little over a year, really trying to help scale Bitcoin while keeping it secure and decentralized, while trying to open up new use cases like Bitcoin DeFi, Bitcoin yield generation, etc. So yeah, really excited to chat.
All right, and Dan, Bakkt.
Thanks so much for having me, Jill. Great to see you again. I'm the Chief Product Officer at Bakkt. We are a crypto infrastructure and platform company. So we help companies that want to be able to list or offer crypto trading to their consumers. We're fully licensed across the whole of the US so that non-crypto companies can offer crypto services to their end users. And on the institutional side, we're also a NYDFS regulated qualified custodian for our institutional custody clients.
All right, and Rika, great to have you with us. Tell us about Bitstamp.
Thank you for having me, Jill. Yes, I'm U.S. Chief Legal Officer for Bitstamp. We are a cryptocurrency exchange and actually the longest running cryptocurrency exchange globally. We have been trading Bitcoin since 2011. The objective for us is, of course, to provide a safe, secure, and regulated trading venue for participants in this space. We hold over 50 licenses worldwide, including the Bit license in New York. So in the US, we operate under the supervision of the New York Department on Financial Services.
All right, and Dan, let's get right into this. Let's talk about the purpose and significance of having, of course, the entire Bitcoin community is certainly looking forward to it. We're starting to hear trickles of it come out in financial media. Why is this such a significant event for Bitcoin?
Yeah, sure. So Bitcoin is an extremely decentralized cryptocurrency, right? There's no issuer, there's no central counterparty, there's no even group behind it that controls Bitcoin. And as such, there is no Fed or central bank that are controlling the issuance rate of Bitcoin. It's all determined programmatically and really was set in stone since the early days of Bitcoin. I think most people now know there's going to be a limit of 21 million Bitcoin that can ever exist. And in order for that 21 million to be issued over time, it has a programmatic issuance schedule that every block, or roughly every 10 minutes, something called the block subsidy, which is essentially a part of the reward given to Bitcoin miners in exchange for mining a block, they receive some new Bitcoin. So the halving is essentially the change in the rate of inflation for Bitcoin. So every 210,000 blocks, or roughly every 4 years, the number of new Bitcoin that are created every block halves, hence the halving term. So the block reward started at 50 Bitcoin, and then 4 years later dropped to 25 to 12.5, and is currently 6.25 Bitcoin. And coming up around April 19th, April 20th, it's still not exactly clear exactly when the date will be. That will drop to 3.125 Bitcoin every 10 minutes. So this is Bitcoin's self-enforced programmatic mechanism for controlling that 21 million limit, whilst providing a subsidy or a reward for the Bitcoin miners who are providing that security service to the network. So the impact is there will be less new Bitcoin produced every day. Currently, there are around 900 Bitcoin mined every day, or increased issuance of Bitcoin, and that will drop to 450 Bitcoin. So in dollar terms of today's price, that's roughly $62 million of new Bitcoin that are entering the market. Some Bitcoin miners are holding those, some are selling them to fund operations. But in total, there's around $62 million of new Bitcoin created per day, which will then drop to 31. So this halving is the fourth halving. And really the market is a very different place from historical halvings. So it's hard to sort of draw direct analogies, but really with the ETFs and with the level of institutional adoption and volumes that we're seeing today, that 31 million new Bitcoin per day is about 0.1% of total trading volume. So not massively significant in terms of the change of supply compared to the amount of volumes of today, but is nonetheless a very significant event that can have impact on the price, have impact on interest in Bitcoin. It's a large marketing event that gets people searching and learning more. And then
Dan, excuse me one moment. Rika, let's get into that for a moment here. Let's talk about the Bitcoin halving history. To Dan's point, it doesn't seem to have that much of an impact on the underlying itself. Are there any historical trends that you can discern from here? What are your expectations going into this event?
Yeah, sure. So there have been 3 halving events in the past. One in 2012, one in 2016, and one in 2020. And as Dan mentioned, another one is expected to take some place in April of this year. And really, if we look back historically, we've seen a bit of a pattern where the market tends to experience increased volatility leading up to these events. So we certainly anticipate an impact this time around as well. We think the upcoming event will be no exception. This sort of anticipation of a reduction and this narrative of scarcity is something that drives a lot of trading activity. Again, looking back historically, after the halving event, there is usually a period of price adjustment, and the immediate impact of the event itself can really differ. We've also observed that historically, the year following the halving event has been really bullish for Bitcoin because each event is really sort of a shift in supply, right? So this, as I said, the scarcity narrative coupled with growing adoption of cryptocurrencies in general, coupled with institutional interest, all of these things affect the price of Bitcoin. Now, I'm not a trader, I'm a lawyer, but I also know that correlation is not necessarily causation, right? So just looking at past performance doesn't really mean that this is how the asset is going to behave in the future. And we could really look at any data set and find relationship between 2 events. It doesn't really mean that one causes the other. So, but what we do expect is certainly some price volatility, increased volatility in the market in the time leading up to the event.
Okay, and Rich, what's the impact on the miners, right? It sounds to me if it keeps getting cut in half and there's less rewards for miners, it kind of doesn't make sense when you think about revenue stream here for them. What's the impact to that?
So I think as it was brought up earlier, so Bitcoin has this beautiful monetary policy that's perfectly predictable relative to something like the Fed, which is almost fly by night at this point. And I think if you think about it from the miner perspective, their business essentially gets cut in half every 4 years in terms of the potential revenue streams they can bring in. And what they're starting to do is start to explore additional revenue streams. And we've actually seen over the last year, things like ordinals and some of these other activities starting to provide more and more transaction fee-based revenue for miners, which is hopefully the offset for the additional reduction in block rewards. As it continues to have a block reward that goes towards zero asymptotically, you'll eventually get to a point where the miners will need to survive totally off transaction fees. And that's been this what if in the Bitcoin space for quite a long time. I mean, how do you get there with this hard ratchet monetary policy? And some of these miners, a great example would be like Marathon, have been producing their own L2s. They're looking into these interesting new private mempools. There's all these additional ways to try to find ways to make it more sustainable for the long term. And this is actually something that Core is looking at, and several of these L2 scaling solutions are trying to find additional ways to provide subsidies to miners to keep Bitcoin secure and decentralized for the long term. And there's already 50+% of the Bitcoin hash rate that's delegating to Core. And that's this long-term evolving narrative of these additional subsidies to keep Bitcoin secure and decentralized. Because if the miners had to start shutting off miners because it became unsustainable, you'd start to question that security budget and whether or not the economics make sense for the long term.
Yeah. You had mentioned before, Dan, that the date isn't exactly set. You know, for example, with equities, if you issue more shares, you know the date it's going to happen. Why is the date not an exact science?
Yeah, sure. So the way the halving works is it's every number of blocks, right? So it's 210,000 blocks that need to be mined before the next halving piece. So Bitcoin doesn't have a direct concept of real world time. And that difficulty of how hard it is to mine adjusts every 2 weeks. But during that 2 week period, you can have spikes of hash rate of how quickly blocks are being mined. Or troughs and slow down. So it really depends on during that period before the difficulty has been adjusted, how much activity, how much mining you're seeing on the network. And given the halving is such a large event, there is a bit of a race to be the miner who wins the block that is the one where the halving occurs, as that's kind of a famous memento, or there are other ways, to Richard's point, to monetize that as well. And so you typically see an increase in the amount of attempts to mine around that time, which can bring that date forward, which means it's not exactly fully predictable.
Do you think this will have an impact on the spot Bitcoin ETFs that were recently approved in the US?
I don't think it will have a direct impact. I mean, this is predictable. There's a lot of debate about whether the price of Bitcoin is the price of the halving or the effects of the halving is already priced in as of today. All this really does is decrease the rate of inflation of Bitcoin. But given the huge volumes that we see largely through the ETFs today, I don't think it'll have a direct impact on the structure of the ETFs itself.
Yeah, and Rika, to your point earlier, it's not as if let's call it price discovery, materializes immediately. It kind of finds its range. I mean, historically, that's been the case.
Yes, and exactly as Dan said, the anticipation of the event leading up to halving is probably to some extent at least already priced into the Bitcoin currently. And then after the halving, there is a period of adjustment. Historically, the year following the halving have seen the price increase of Bitcoin, but again, there are many different factors, that might influence the macroeconomic trends, regulatory development, technological advancements. So it's really hard to say what exactly influences the price of Bitcoin.
So, Rich, it almost sounds to me, you would think if you're having supply here that it would put a floor underneath it or certainly some support, but it sounds as if there's other parts of the industry or the product itself that gets impacted. Like to your point, miners, right? It's more impactful to them than it necessarily is for support for the price of Bitcoin.
Yeah, Bitcoin has so many different audiences and so many different network participants. The miners feel the most direct impact of the halving. The scarcity impact, as Rita was talking about earlier, is felt by more of the Bitcoin holders, the other participants. And we haven't seen what is much will happen in that case here. We've never seen the BlackRock bid before, right? Like this cycle could truly be different. Historically, we've seen that year of kind of consolidation and then the next bull run that kind of comes the year after. However, we've never seen anything like this, and especially watching the recent ETF inflows, we're already pacing some days that are 3 times, 4 times what these new emissions will be. So we've just never really seen that. In theory, that will take some of the pressure off the miners as the price of Bitcoin continues to hopefully trend in a positive direction. But there's a lot of doubts on, kind of what will happen in the short term.
Is the transaction fee model sustainable? I mean, let's say you have more miners come on and there's more competition within this space, then there's going to be pressure on the fee side, right?
So there's going to be pressure on the fee side, at least for the short term. But I think as we think about some of the Bitcoin scaling solutions like Core or some of the Bitcoin L2s, by using Bitcoin as the state that they write back to, that will provide potentially a long-term form of transaction fees to keep the Bitcoin L1 healthy and sustainable. And that is hopefully a much more predictable source of transaction fees than things like Portals and BRC20s that actually do provide a lot of utility to Bitcoin holders, which is great. However, with having that, it comes in waves of fluctuation in demand. Ideally, Bitcoin L1 will have this continuous security budget and continuous demand for far into the future.
Right. So Dan, it almost seems like rather than thinking about Bitcoin in terms of trading and price movement, to shift gears and think of it as a utility and a longer term solution and not be so focused on the nuances of the price discovery part of it.
Yeah, I mean, absolutely. I mean, I think that's really what I've been most passionate about, and what brought us a lot into the space is actually the use of Bitcoin. A lot gets tied to the digital gold sort of store of value narrative, and obviously, I think when Satoshi created the hard cap, that was in mind to have that analogy with gold, and the fact that it's scarce to mine, and that goes down over time. But to Richard's point, as that block subsidy decreases, fees need to, well, either the price needs to double or fees need to increase to compensate for the reduction in the rewards. And that is really ultimately going to come through a fee market based on usage and value that getting your transactions into blocks provides you. And that will come from largely either Bitcoin will sort of be reduced to an L1 pure sort of settlement network for extremely high value transactions where people will be prepared to pay higher fees, or a combination of that and increased usage from L2s and everyday demand for payments or remittance or any number of more utility-based use cases.
Yeah. Do you buy into the digital gold narrative? I feel like it's trying to almost pigeonhole it into, an existing type of asset class when the properties are different.
I think analogies are helpful, right, to help people get a base understanding, but they can also be harmful if you get too strictly stuck within them. And I think Bitcoin as digital gold has been a very helpful analogy for what is a very esoteric, difficult to understand for normal people, new concept entirely. And there are enough analogous properties of Bitcoin to make that case. And really, that's just been the sort of phase one use case narrative and understanding. But we shouldn't limit our thinking based on, well, what can I do with gold? What can I do with a digital equivalent of gold that really can be so much more, and was designed in the white paper to be a peer-to-peer electronic cash use case.
Yeah. Rika, what are your thoughts on that? I mean, especially being on the legal side of the house, you can't necessarily always interpret things. There has to be some sort of guidance there. How what's your ethos?
Well, I sort of, subscribe to Dan's logic that this is a brand new asset class. It's helpful to compare it to something similar or existing assets out there, just for people in general to wrap their head around what it is and what can be done with it. But it's important not to get boxed into this definition, right? So it's interesting how in the past couple of years, there's been a lot of efforts to figure out how Bitcoin can be used beyond just a store of value. Mm-hmm. And it's something that we've mentioned, the various scalability projects and things like that.
And Rich, final thoughts here.
Yeah, so I think to echo some of the initial sentiments there, the kind of next wave of Bitcoin is moving beyond just digital gold. Digital gold is a perfect use case for billions of people around the world. However, in order to feel that all the way through, we have to do some of the scaling off of Bitcoin L1. It's just not designed to do that. It'll price out so many people. So that's where these scaling solutions come into play. And you'll start to see a bunch of themes and narratives emerge of like separating Bitcoin, the asset, from Bitcoin L1, the rail. You'll see non-custodial Bitcoin staking that will come into place. You'll see Bitcoin DeFi on top of all these new narratives like NFTs and other things. So it's really an exciting time to be in Bitcoin, and it's really getting towards the original Satoshi vision of Bitcoin as money, which is just not going to be able to be possible on Bitcoin L1 itself.
Got it. All right. We appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.